Imagine this. You wake up, check the news, and see that the stock market has hit a record high. Should you invest? Should you sell? Or should you do nothing? The world of investing can seem overwhelming, filled with jargon, risk, and uncertainty. But here's the good news. You don't need to be a Wall Street pro to make smart investment decisions. Today, we're breaking down the most common investment types: stocks, bonds, mutual funds, and ETFs, so you can start investing with confidence. At its core, a stock represents ownership in a company. When you buy a stock, you're essentially buying a small piece of that business. The value of your stock depends on the company's performance and how much investors are willing to pay for it. Example: think of stocks like owning a slice of pizza. If you own a slice, you're entitled to a portion of the pizza's value and earnings, just like in a company. Common stocks. The most popular type of stock is common stock. When you own common stock, you get voting rights and potential dividends, but you're also taking on more risk: preferred stocks. Then there's preferred stock. These don't usually come with voting rights, but they offer fixed dividends, meaning investors get paid before common stockholders if a company distributes profits. Capital appreciation. This is when the value of a stock increases over time. If you bought Netflix stock in 2010 at $20 and sold it in 2021 for over $500, that's capital appreciation. Dividends. Some companies pay shareholders a portion of their profits in the form of dividends. Think of it like getting a paycheck just for owning a stock. The stock market can be a powerful wealth-building tool, but it comes with risks. Stock prices fluctuate daily based on company performance, economic conditions, and investor sentiment. Example: if you had invested in Amazon early on, you would have experienced multiple drops of 30% or more. But those who held on long-term saw massive gains. Active investing. Active investing is when you buy and sell stocks frequently, trying to beat the market. This requires research, time, and risk-taking. Passive investing. On the other hand, passive investing is about buying and holding for the long run, often using index funds like the S&P 500. Bonds are one of the oldest and most reliable investment options, but many people don't fully understand how they work. In this video, we're breaking down different types of bonds so you can make informed investment decisions. At its core, a bond is a loan you give to a government or a company. In return, they promise to pay you back with interest. Think of it as an IOU with benefits. But not all bonds are created equal. Let's explore the main types. First up, we have U.S. government bonds, also known as treasuries. These are some of the safest investments in the world because they're backed by the full faith and credit of the U.S. government. Treasuries come in different forms: treasury bills, T-bills, mature in 1 year or less. Treasury notes last between 2 to 10 years, and treasury bonds can go up to 30 years. Because of their low risk, they also tend to have lower returns. But if safety is your priority, treasuries are a great choice. Next, we have corporate bonds, loans issued by companies to raise capital for expansion, innovation, or operations. These bonds offer higher interest rates than government bonds because they come with higher risk. Corporate bonds are rated based on the issuing company's creditworthiness. Investment-grade bonds are issued by financially stable companies and offer lower risk, while high-yield bonds, sometimes called junk bonds, carry more risk but offer higher potential returns. Ever wonder how cities fund schools, roads, or public projects? That's where municipal bonds, or munis, come in. These are issued by state and local governments to finance community projects. One major perk of munis? Many are tax exempt, meaning you don't have to pay federal income tax on the interest you earn. Some are even exempt from state and local taxes, making them an attractive option for high-income investors. Looking beyond the U.S., international bonds offer diversification. These can be issued by foreign governments or corporations. But keep in mind, while they can offer higher yields, they also come with currency risks and geopolitical uncertainties. Emerging market bonds issued by developing countries offer even greater potential returns but come with economic and political risks. If you're looking to explore global opportunities, international bonds might be worth considering. For those looking for ultra-safe investments, savings bonds and Series 1 bonds are great options. These are government-issued and designed to protect against inflation. Series I bonds, for example, adjust their interest rates based on inflation, ensuring that your purchasing power remains intact. They're especially useful during times of economic uncertainty. So, how do you choose the right bond? It all depends on your financial goals. If safety is your top priority, treasuries or savings bonds might be your best bet. If you're looking for higher returns, corporate or emerging market bonds could be worth exploring. And if tax benefits appeal to you, municipal bonds might be the way to go. Before investing, always consider factors like interest rates, credit ratings, and your own risk tolerance. And remember, diversification is key to building a strong investment portfolio. Understanding bonds is an essential part of smart investing. Whether you're looking for stability, income, or growth, there's a bond for you. So, what's your investment strategy? Choose wisely.